Welcome to the Thematic Edge. I'm Marvin Barth of Thematic Markets. This week we're doing something different because I was privileged to be invited to the Hoover Institution to speak at their annual Monetary Policy Conference. I'd like to thank the conference organizers, Michael Bordo, John Cochrane, and Valerie Ramey for the invitation. I've been to a number of different monetary policy conferences over the years, and the Hoover Conference is by far the best of them in content, format, and caliber of discussions. I had hoped to do a number of sideline interviews, but because the conference was so well organized and packed with content, there was only time for a few, with John Cochrane, Randy Quarles, and Darrell Duffie. Unfortunately, another with Michael Bordo suffered an audio failure. Before I turn to those interviews, I want to give you some of the big picture takeaways that I gleaned from the conference. The theme for the conference was independent structure and risks ahead for central banks, which is testament that even 358 years after the Swedish Riksbank, the first modern central bank, was founded, economists are still debating the proper structure and functioning of central banks. To that point, while the 6 panels did provide many great insights on how to improve central banking, I think it raised as many questions as it provided answers. I was pleased to see that the subtext of my own remarks, the need to integrate political economy into economic analysis, was also emphasized by such heavyweights as former Secretary of State and current director of the Hoover Institution, Condoleezza Rice, and Harvard professor Ken Rogoff. The world is complex, and economic policy cannot be made in a vacuum or based on models alone. Relatedly, Thomas Drexel of the University of Maryland presented his analysis of recent Fed chairs' calendars, which was revealing. Readers of my research know that one of the things that I appreciated about former Fed Chairman Alan Greenspan was his constant pulse checking with business leaders to see what was happening on the ground in the economy. In contrast, Thomas found that recent chairs only really talk to business leaders during periods of crisis, meaning that they have lost a key source of alternative insights into the real state of the economy. One of the most interesting panels that delivered some of the clearest takeaways was on central bank mandates. Carolyn Wilkins of Princeton University showed how the increasing demands on the Fed to regulate banks has eroded their ability to focus on their core mission of price stability. But even for central banks with more tightly prescribed mandates, like the European Central Bank, Luis Garicano of the London School of Economics showed that without political oversight to enforce those tight mandates, central banks can expand the definition unilaterally as the ECB has. At its limit, monetary policy will be dictated by fiscal policy, and that is currently a serious risk to central bank independence. If the government runs out of fiscal space, if it is intent on avoiding outright default, it has no choice but to co-opt the central bank. One clear way to see that is through what's called the fiscal theory of the price level. Conference organizer John Cochrane is one of the main proponents of the theory, and I had the opportunity to ask him about it. Here's what he had to say. Well, I have John Cochrane, who is not only one of the organizers of this fantastic conference at the Hoover Institute on monetary policy, but he is also the Mary and Jack Anderson Senior Fellow at the Hoover Institute.
That's right.
And so you are the man of the hour here.
Well, one of three.
And you also have the distinction, I have to say, of being probably my all-time favorite well-rounded economist. You have written so much amazing research on literally every topic, from finance to economics,
Health economics even, yes.
everything, and it's all really amazing stuff. And the other thing that I love about it is you write really well, so it's actually really easy to read.
It's hard to write.
Yes, I highly recommend The Grumpy Economist. It's one of my favorite reads.
Thank you.
But one of the ideas that you're perhaps most famous for, certainly in economics, is your thoughts around the fiscal theory of the price level. And so how would you explain the fiscal theory of the price level to a broad general audience so they could understand that?
It's really common sense, and you'd be surprised why is this at all controversial. Where does inflation fundamentally come from? And by that I mean the level of all prices and wages. What gives the dollar its value in the end? And the answer to that is that the dollar is part of government debt. And it comes from people's faith in the government. So the central thought is that the value of government debt equals the present value of the primary surpluses that repay that debt. What does that mean? That's just like saying the value of a stock is the present value of the dividends that you're going to get for the stock. So the government borrows money and then pays it back.
Yeah.
So the value of the government's debt that it's borrowed is the value of what you expect to get paid back. If you think those jokers in Washington are never going to get around to, raising enough taxes over their spending to pay back the debt, what do? You try to get rid of the debt. And the debt and money are all sort of the same thing. Money is just a form of government debt. Well, if we try to get rid of debt, the only way to do that is to try to buy stuff. And as you buy stuff, you drive up the price of goods and services. That's where inflation comes from.
Yeah, no, that is a fantastic explanation. And, it comes direct, it goes so close to one of the reasons or the things that I explain hyperinflation is happening is exactly to your point. Effectively, the government issues two liabilities, one that bears coupons and has a maturity date, and one that doesn't bear coupons. And as long as everybody's willing to accept it, it's zero maturity. But the day people start to question whether they want to accept it because they think that the government's using it to finance, it becomes an infinite maturity bond, which has price zero.
Debt is really just, government debt is a promise to pay money in the future. So it really just smears this whole business out over time. But if there's more money floating around relative to the government's ability and will to soak up that money with taxes, you get inflation. And bonds are just promises that there's going to be more money in the future, so you think about the future taxes, but that's the idea.
And this was a big theme at the conference today, where people were talking, the first few panels were exactly on this issue. So how should we be thinking about the risks to central bank independence right now in an environment where there are lots of questions about U.S. fiscal sustainability?
And I should say, the fiscal theory just generalizes and formalizes ideas people have understood for hundreds and hundreds of years. So the fact that governments are tempted to print money to bail themselves out of financial trouble, and that when they print that money, you get inflation. That happened in the French Revolution, that happened in the Spanish Empire, that happened after World War I. We've seen this story over and over. And central banks actually historically were set up to, it was a very smart thing our forebears did. If you set up a central bank that says, no, we're not going to allow you to print money to get out of your deficits, then you, the government, pre-commit that you're going to have to raise taxes to pay back your debt.
Yeah.
And that's wonderful for being able to borrow in the first place.
Yes.
Why do people lend money to governments when governments can always just print money and inflate away your debts? Well, because the governments have pre-committed that it's going to be really hard to do that. And that's what central banks are invented for. So the whole idea of an independent central bank with a limited mandate that's supposed to pay attention to inflation is a way of the government pre-committing itself that it's going to be really hard later to print up money and cause inflation. So that's why central bank independence and its mandate to price stability are really important. Now, I'm sorry, you asked the question today.
Yeah.
We've lived through 50 years where this wasn't a big issue since World War II. But our debt and deficits now make it a big issue. And our central bank is going to face fiscal problems in a way that nobody's been thinking about for 50 years. Right now, if the Fed raises interest rates 1%, that causes 1% of GDP, that causes 1% more in interest costs on the debt, which at 100% debt to GDP is 1% of GDP more deficit. Every percent the Fed raises rates is a percent more deficit. How's Congress going to feel about that?
Yeah.
just ask yourself. And you already, President Trump said lower interest rates because I want lower interest costs on the debt. And that's just the beginning. In COVID, the Fed bought a lot of Treasury debt to monetize the debt, and we got inflation. That's going to happen again in the next crisis. So when we have these big debts and unresolved deficits looking forward, we're facing these classic issues that go back centuries, not just a little Phillips curve stimulus.
Well, thank you very much. I really appreciate you taking the time to spend with us on the Thematic Edge.
It's been a pleasure. Thank you.
For all the concern over central bank independence, Edward Nelson of the Federal Reserve Board showed that the Fed is structurally well protected from political pressure, given the diffusion of power between the Board of Governors, each of whom has a 14-year term, and the Reserve Bank presidents. On the same panel, Gary Richardson of UC Irvine challenged some of the conventional wisdom that central bankers like Arthur Burns had bent to the will of the president, showing archival evidence that it was rather the reverse, i.e. that Richard Nixon's price controls were at Arthur Burns' behest. However, David Wilcox of the Peterson Institute and formerly of the Federal Reserve Board highlighted something that I have at Seriously Marvin in my piece, The President's Problem, linked in the comments below, that the next battleground for control is likely the presidents of the reserve banks. Yet we differ on what the goal of seizing the presidencies is. David, like most of the conference participants, was focused on their potential to swing monetary policy votes towards fiscal dominance, whereas I think the real focus is bank reform and bank regulation. That's where the Federal Reserve banks are critical as regional regulators. This is one area where I think there could have been more discussion. Whether executive branch control of the Fed is really about monetary policy or bank policy. This is the flip side of Carolyn Wilkins' point about the dilution of the Fed's mandate to include bank regulation. That is, that it becomes a prize in and of itself. That prize has accompanying risks. I had a wonderful interview with Michael Bordo, one of the conference organizers, and a fabulous economic historian at Rutgers University. But unfortunately, the audio file was corrupted, so I can't play it for you. But he generally agreed with my analysis that President Trump is effectively a representation of Jacksonian populism. Yet he had a warning based upon that I hadn't considered. In his view, President Jackson's destruction of the second bank of the United States led to 80 years of banking crises that countries like the UK avoided by having a central bank. While I do not anticipate the outright destruction of the Fed, a push for rapid bank deregulation by the Trump administration runs similar risks. While bank deregulation and balance sheet downsizing were not discussed too much at the conference, I did get a couple of great interviews on what the likely timeline is with former Vice Chairman of the Federal Reserve, Randy Quarles, and Stanford Graduate Business School professor Darrell Duffie, one of the few people at the conference who did discuss the subject. Readers of my research know that I see this as the top priority of the Trump administration and incoming Fed Chairman Kevin Warsh. But both Randy and Darrell cautioned this is going to be a long, maybe even a decade or more, process. Here's Randy's take. Randy Quarles, welcome to the Thematic Edge. You were Vice Chairman of the Federal Reserve for Supervision. You're now Chairman of the Sinosure Group. And you are also an avid Thematic Market subscriber, so I love to see that. Question, you've seen that I've written a lot about the likely path towards deregulation and downsizing the balance sheet at the Fed, and that those are effectively twin goals. They have to be pursued together because of what regulations force banks to hold in terms of all the different Basel III ratios. Now, this was something that you were very familiar with. You're now also on the chairman of the Financial Stability Committee for the DIS. How realistic is that? And how do you see this process taking place?
So, I think the deregulatory program or the right sizing regulation with respect to banks, I think that's very realistic. But the realistic time frame for it to really be effective is fairly long. For a real deregulatory program, and when you consider the Trump deregulatory program writ large, beyond banks as well, which I think is the most consequential element of the Trump economic program, that probably requires a couple of ideologically aligned administrations in a row in order to get done, just because of the legal requirements for regulatory change. And in the banking area, you have to layer on top of that supervisory practices. Yeah. So the written regulations are one thing, the way that they are implemented through supervision is another, and then supervisory practices that aren't part of regulation at all, but are very important for the banks and very important for the Fed's balance sheet.
Yes.
Also factor in there. So right now, one of the big drivers of the Fed's balance sheet, in addition to the demand for currency that's out there, is banks' demand for reserves at the Fed.
Yeah.
And some of that is driven by the change in policy, so that the Fed now pays interest on reserves. But post the great financial crisis, there is a huge increase in focus at the institutions themselves on their intraday liquidity. Post the great financial crisis and post SVB.
Yeah.
I mean, an issue you had at SVB was that this money was leaving during the day, and if it could have had a day in order to get collateral at the Federal Reserve, if it could have had a day to settle some sales of treasuries, that might have been enough. But the money was going out during the day, and the liquidity that it needed during the day was very substantial, much more substantial than history would have told us was typical for any bank, even a bank that was undergoing a run. So that demand for reserves is not just a function of regulation and supervision, although that is a strong element of it. We have regulation that requires high levels of liquidity at the banks. I think that's probably counterproductive, that we have, to some extent, by regulation, recreated the unstable banking system of the 19th century, requiring every bank to have its own liquidity, as opposed to looking to a central source of liquidity, which is the whole purpose for creating the Fed. We also have supervisory practices that place a heavy emphasis on satisfying intraday liquidity, which you can't do under those supervisory practices with Treasury securities. So there's a heavy thumb on the supervisory and regulatory scale towards bank reserves. But there's also a very strong desire banks have become not only comfortable with, but strongly aligned with the notion that they should have high levels of intraday liquidity, which can only be satisfied by having high levels of Fed reserves, which creates a very large balance sheet.
Yeah.
So to shrink the balance sheet in a meaningful way, and I think there are lots of things that the Fed can do with its balance sheet, that the new chair can do that will be useful, but to really shrink it meaningfully would require changing that demand. It would require changing the regulatory structure beyond what has currently been proposed. It would require changing supervisory practice beyond what is currently on the table. It would require changing the bank's own demand functions for reserves in a way they'd have to get used to regularly using the discount window or some other Fed facility to satisfy their intraday liquidity needs in a way that they just haven't for a long time, and so they're very comfortable holding these high levels of reserves. And then, quite separate from that, you'd have to change the way the Fed implements monetary policy, which, since the move to a very large balance sheet, as everyone knows, is handled through administered rates. The Fed just says this is what we're going to pay on reserves, and that effectively, sets the parameters for the for interest rates in the financial system. And to really shrink the balance sheet, you now wouldn't have enough reserves to have enough leverage to do that if you'd made a big change in the balance sheet. And so you'd have to go back to the old operating system, which required market intervention. That requires the Fed redeveloping reflexes that for a quarter of a century almost it hasn't had. And, and that the institution is loath to go back to because the current system, they believe, and with some justice, it's certainly easier, but it's also kind of more precise, more effective than the old market intervention system. So those are doing all of that, changing the regulation, changing the supervisory practice, changing the bank's demand function for reserves, changing the Fed's monetary policy implementation practices. This is a dive of a very high degree of difficulty that's going to require a long time to do. You're going to have to convince people intellectually that that's the right thing to do. Then you have to work out the plan for how to achieve all of these various elements and kind of achieve them simultaneously. And then you have to execute on that plan. And it's certainly years. It's probably a decade if you really wanted to seriously change the size of the Fed's balance sheet to do that. And again, there's lots that can be done. There's lots that's useful that can be done faster than that. But the size is a difficult thing to engage on.
One quick question on that. Are there any quick wins that you think that Chairman Warsh could post right away? And what would those be? What do you think would be the sort of top things that he would move forward with if this is the agenda?
Yeah. With respect to the balance sheet, I do think that a quick win that would be useful to do, that is that is implementable and executable and useful, would be to change the composition of the Fed balance sheet. There's a large pool of asset-backed securities, MBS, that are currently in the Fed balance sheet. I think I certainly agree with the arguments, and more importantly, I think that a majority of the FOMC agrees with the arguments that on balance, an all Treasuries balance sheet is best for the Fed. They've been reluctant to move quickly towards getting these MBS off the balance sheet and replacing that with Treasury securities for fear of disrupting the MBS market. Reasonable concern, but I do think that there are mechanisms that the innovative and creative mechanisms that the Fed could look at that would allow it to accelerate the transition of the balance sheet to an all Treasuries balance sheet, which is a useful thing to do. And, at the margin, you could shrink it a little as part of doing that, which sends a decent signal. And that's achievable at a much faster rate, I believe, than shrinking the balance sheet dramatically.
Okay. Well, thank you very much, Randy. I really appreciate you making the time for us. It's great to see you here at the conference, and thanks again.
Thanks for having me.
Randy's prognosis was backed up at a granular operations level by Darrell Duffie's presentation. Darrell kindly agreed to explain in a brief interview here. Welcome, Darrell Duffie, Professor of Finance at the Graduate School of Business here at Stanford. We're at the Hoover Conference, and you and I just were on a panel together. Thank you for coming on the Thematic Edge.
It was great to talk with you, Marvin, and to speak on the panel with you.
Well, it was a great experience, and I really was intrigued by what you were talking about the ways that the Fed can slim down the balance sheet. You, of course, have just written a paper at Brookings Institution on how to slim down the Fed balance sheet. What are the sort of ways that they can do that? And earlier I was talking with former Vice Chairman of the Fed for Financial Supervision, Randy Quarles, and he was suggesting that this is a process that's going to take a decade to rewrite the rules, to adjust the regulation. This doesn't even need congressional. We're not even talking about getting this to go through Congress. This is just reorganizing the Fed around the existing Dodd-Frank rules. What do you see as the likely path here? Are there any sort of quick wins that a Chairman Warsh could achieve coming in the door, or how is this process going to work, and how long is it really going to take in your view?
Well, of the measures that I discussed today at the conference, The quickest one is temporary open market operations that would smooth out the path of reserve balances so that without these potholes and bumps, banks are able to more easily meet their needs every day. The unfortunate thing is that's not going to buy more than, let's say, $100 or $200 billion of reduction in the average path of reserve balances. If you want to go for the bigger ones, you have to, as you suggested, redesign regulation, or at least coach banks and bank supervisors about how to use liquidity regulations in a way that allows banks not to rely so heavily on reserve balances to meet their liquidity needs. As it is today, the easiest way for the banks to make sure they don't run afoul of those regulations is just stack up a ton of reserves on their balance sheets. Some of the other approaches that I suggested would take a big retooling of Fed monetary operations. One of them was changing the payment system. That's not something you do by changing a few lines of code and then letting it, testing it in a matter of weeks. Fedwire, which is the largest payment system, is $4.5 trillion a day of payments. And so that would take years of testing and integration with large bank internal payment systems. That's not going to happen in even a few years. It's going to take longer than that. Another approach I suggested would take a huge amount of study. It would be quite effective, and that's tiering the remuneration of reserves so that banks don't get paid a full interest rate on any amount of balances that they hold, but rather once they have enough reserves to meet their day-to-day business operations, they get a lower interest rate on the excess. That's been done successfully in other countries. To implement that here in the United States, how much reserve balances is enough for each type of bank? It's going to be a big, first of all, a big research question for the Fed to deal with. And then secondly, a big negotiation, because the largest banks are not just going to roll over and say, okay, they're going to be arguing, well, we need a lot more reserves than that because it's a matter of profitability and the ease with which they run their business operations. So that's a huge negotiation. There could be a lot of pushback, and pushing that through could, even if it doesn't require a new regulation, could take years.
Okay, so this is not something that's going to happen overnight. There's nothing that's going to move quickly here, and so I shouldn't expect that Chairman Warsh is going to announce, yeah, we're going to sell off $1 trillion in 10-year duration tomorrow, and
not at all. I mean, first of all, the Fed has a lot on its plate right now, particularly with different views within the FOMC on setting interest rates, short-term interest rates. And my guess is the chair and the FOMC will be fully occupied for a long time just getting together on what its rate policy should be. At the same time, I wouldn't be surprised if at least some studies or planning groups are set up to look at this issue of the balance sheet. But it'll be a long time before an actual change comes. And I wouldn't expect the Fed to jump into anything very quickly. The Fed's a very careful and conservative organization.
Yes, as I know from the years there. Thank you very much, Professor Duffie. I really appreciate you making the time for us. Thank you again.
Marvin, it was a pleasure.
So what did I talk about at this conference? Well, you can read my full remarks at Seriously Marvin in my latest piece, Themistocles' Lessons for the Fed. But my main message is that the Fed has created its own problems through policy errors that result from over-reliance on flawed models and from not having the humility to admit its errors and pursue internal reforms. While I stand behind everything that I said, I was perhaps a bit harsh in some of my rhetoric. And I have to say that because all 4 FOMC members on the panel that followed mine, Vice Chair Bowman, Governor Waller, and Presidents Daley and Goolsbee, were incredibly gracious. Vice Chair Bowman laid out in clear terms her approach to redress some of the worst facets of current bank regulations. President Daley focused on building a broader toolkit for analysis of the economy to avoid some of the problems that I critiqued. President Goolsbee illustrated well a point that I have repeatedly made in contrast to Fed Governor Mirren and incoming Fed Chairman Warsh, that an expected positive productivity shock is not disinflationary and requires higher interest rates. If you'd like to read the background papers or watch replays of the conference panels, I'll put those in the comments below as they become available. In the meantime, thank you for joining me again on the Thematic Edge. I'll be back in 2 weeks with my usual co-host, Mark Farrington of the Global Watchtower.